your bank is lying to you. Right now, as you're watching this video, every dollar sitting in your savings account is quietly losing value. The banks tell you your money is growing with that pathetic 0.5% interest rate, but here's the brutal truth they don't want you to know. Inflation is eating your wealth alive, and they're profiting from your ignorance. While you think you're being safe with your cash in the bank, the wealthy are laughing all the way to, well, different banks, because they know something you don't. They know that cash isn't king anymore, it's the court jester, and it's making a fool out of everyone who believes in it. Listen carefully, because what I'm about to reveal will either change your financial life forever, or you'll ignore it and watch your purchasing power evaporate year after year. If you're serious about building real wealth, if you're tired of watching your money lose value while the rich get richer, then you need to watch every second of this video. I'm going to show you 6 assets that the wealthy use to not just protect their money, but multiply it while everyone else gets poorer. But here's the thing. This only works if you're willing to think differently than 95% of people. So if you're ready to stop being a victim of the financial system and start playing by the rules the wealthy play by, hit that subscribe button right now, and let's dive into the secrets they don't want you to know. 1. God's money, precious metals. For over 5,000 years, there's been one form of money that has never gone to zero. One asset that has survived the collapse of every empire, every currency, and every financial system. The Romans called it aurum. The Egyptians called it the flesh of the gods. Today, we call it gold, and it's still the ultimate insurance policy against government stupidity. Here's what your banker won't tell you. While your dollars are being printed into oblivion, gold has increased in value by over 500% since 2000. That means if you had put $10,000 in gold instead of the bank 20 years ago, you'd have $50,000 today. Your bank account, it would still be $10,000, but worth half as much in real purchasing power. But gold isn't the only precious metal that's making people wealthy. Silver, often called the people's money, has industrial applications that make it even more valuable. It's used in solar panels, electronics, medical equipment, and water purification systems. As the world goes green and technology advances, silver demand is exploding while supply remains limited. Platinum is another powerhouse that most people ignore. It's rarer than gold, essential for catalytic converters in cars, and crucial for hydrogen fuel cells, the energy technology of the future. While everyone's focused on Bitcoin, smart money is accumulating physical platinum. The beauty of precious metals is their simplicity. No counterparty risk. No CEO can run them into the ground. No government can print more of them. They just sit there holding their value while paper currencies turn to confetti. And here's the kicker. You don't need to store gold bars in your basement. Gold ETFs like GLD and IAU give you exposure to gold prices without the storage hassles. But remember, if you don't hold it, you don't own it. Physical metals are the ultimate hedge against system collapse. Second, industrial commodities, the building blocks of civilization. While precious metals protect wealth, industrial commodities create wealth. These are the raw materials that build our world: copper for electrical wiring, lithium for batteries, rare earth elements for smartphones and wind turbines. Take copper, for example. It's called doctor. Copper because it has a PhD in economics. When copper prices rise, it means the economy is growing because copper is needed for everything from construction to electronics. China alone consumes 50% of the world's copper supply. As developing nations industrialize, copper demand will skyrocket. But the real money is in the commodities driving the green energy revolution. Lithium has gone from an obscure metal to white gold because every electric vehicle battery needs it. Bolivia and Chile control most of the world's lithium reserves, creating a supply bottleneck that's pushing prices through the roof. Then there's cobalt, essential for electric vehicle batteries and currently controlled by politically unstable countries like the Democratic Republic of Congo. As Tesla and other EV manufacturers scale production, cobalt prices could explode higher. Rare earth elements are perhaps the most strategic commodities of all. China controls 90% of global production, and these elements are crucial for everything from military equipment to renewable energy systems. As geopolitical tensions rise, countries are scrambling to secure their own supplies, driving prices higher. The best part? You don't need to buy physical commodities. You can invest in mining companies like Freeport-McMoRan for copper, Albemarle for lithium, or ETFs like DBA for agricultural commodities. When inflation hits, commodities always outperform cash. 3. Safe haven currencies. Not all money is created equal. Here's something that will blow your mind. Not all currencies are worthless. While the dollar is being debased, some currencies are actually backed by real economic strength, political stability, and sound fiscal policies. The Swiss franc is the ultimate safe haven currency. Switzerland has been neutral for over 200 years, has one of the world's strongest economies, and their central bank is far more conservative than the Federal Reserve. When financial crises hit, money floods into Swiss francs like water flowing downhill. During the 2008 financial crisis, the Swiss franc gained 25% against the dollar. During the European debt crisis, it gained another 30%. Smart money doesn't just flee to gold during chaos, it flees to Swiss francs too. But Switzerland isn't the only game in town. The Norwegian krone is backed by massive oil wealth and $1 trillion sovereign wealth fund. The Canadian dollar benefits from vast natural resources and a more stable banking system than the U.S. Even the Chinese yuan is gaining strength as China becomes the world's manufacturing powerhouse. The Singapore dollar is another hidden gem. Singapore has zero natural resources but has built one of the world's most efficient economies through smart policies and strategic location. Their currency has steadily gained value for decades. You might think you need millions to access foreign currencies, but that's not true. Currency ETFs make it easy to diversify across multiple currencies. FXF gives you Swiss franc exposure, FXC tracks the Canadian dollar, and CYB follows the Chinese yuan. With just a few $100s, you can protect yourself from dollar devaluation. 4. Sovereign guarantees. When governments back your money. Here's a secret the wealthy have known for centuries. The strongest investment is one backed by the full faith and credit of a stable government. But not just any government. You want governments that have never defaulted and have the power to honor their promises. U.S. Treasury securities are still the gold standard of sovereign guarantees. Despite America's problems, the U.S. government has never defaulted on its debt, and the dollar remains the world's reserve currency. Treasury bonds offer better returns than bank savings accounts and are backed by the world's most powerful military and economy. But here's where it gets interesting. You can buy Treasury securities directly from the government through treasurydirect.gov, cutting out the banks entirely. Treasury bills, notes, and bonds offer different time horizons and interest rates, all guaranteed by Uncle Sam. German bonds are another excellent sovereign guarantee. Germany has the strongest economy in Europe, runs budget surpluses, and has a culture of fiscal responsibility. German government bonds offer exposure to euros while providing government-backed security. Japanese government bonds might seem counterintuitive given Japan's massive debt, but here's the thing. Japan owns its own debt, and the yen is a safe haven currency during global crises. Japanese bonds have provided steady returns for decades. The key is diversifying across multiple sovereign guarantees. Don't put all your trust in one government, no matter how stable it seems. History is littered with risk-free governments that eventually defaulted. Even municipal bonds from stable U.S. cities and states can provide tax-free income that beats bank interest rates. California munis, New York City bonds, and Texas state securities all offer government backing with tax advantages. 5. Value stocks and dividend funds, owning pieces of profit machines. Stocks aren't just pieces of paper. They're ownership stakes in profit-generating machines. But not all stocks are created equal. While growth stocks can be volatile and speculative, value stocks with strong dividends are like owning rental properties that pay you every quarter. Think about companies like Coca-Cola, Johnson & Johnson, and Procter & Gamble. These aren't exciting tech startups. They're boring, profitable companies that sell products people need every single day. Coca-Cola has paid increasing dividends for 60 consecutive years. That's not speculation, that's a money machine. Utility stocks are particularly attractive in inflationary environments. People need electricity, water, and gas regardless of economic conditions. Companies like NextEra Energy and Dominion Energy offer dividend yields that crush bank interest rates while providing essential services. Real estate investment trusts, REITs, combine the benefits of real estate ownership with stock market liquidity. REITs like Realty Income, known as the monthly dividend company, pay dividends every month, not quarterly. They own thousands of properties leased to stable tenants like Walgreens, McDonald's, and Dollar General. For investors who don't want to pick individual stocks, dividend-focused ETFs do the work for you. The Vanguard Dividend Appreciation ETF, VIG, holds companies with long histories of increasing dividends. The SPDR S&P Dividend ETF, SDY, focuses on companies with at least 20 consecutive years of dividend increases. The magic of dividend stocks is compound interest. When you reinvest dividends to buy more shares, which pay more dividends, which buy even more shares, your wealth snowballs over time. This is how the wealthy get wealthier. They own assets that pay them to own them. Sixth, land and real estate. They're not making more of it. Mark Twain said it best, buy land, they're not making it anymore. Land is the ultimate finite resource. Every human needs somewhere to live, work, and play. As population grows and urbanization continues, land becomes more valuable. But real estate isn't just about buying a house. Commercial real estate generates income through rent while appreciating in value. Office buildings, shopping centers, warehouses, and apartment complexes all provide cash flow plus inflation protection. The secret sauce is leverage. Banks will loan you 80% of a property's value at low interest rates because real estate is excellent collateral. If you buy a $100,000 rental property with $20,000 down and it appreciates 5% per year, you're earning 25% returns on your invested capital, 5% gain on $100,000, $5,000 profit on $20,000 invested. Real estate investment trusts, REITs, make real estate accessible to small investors. Realty Income owns over 11,000 properties leased to stable tenants. Digital Realty Trust owns data centers, the backbone of our digital economy. American Tower owns cell phone towers that generate increasing rents as data usage grows. For accredited investors, real estate crowdfunding platforms like Fundrise and Yield Street offer access to commercial real estate deals that were previously only available to institutions. You can invest in apartment buildings, medical facilities, and industrial properties with minimum investments as low as $500. International real estate provides additional diversification. Properties in stable countries like Canada, Australia, and Switzerland offer exposure to different currencies and economies. Some countries even offer citizenship through real estate investment programs. 7, collectibles, passion investments that appreciate. The ultra-wealthy don't just invest in boring assets, they invest in things they love that happen to appreciate in value. Classic cars, fine art, rare watches, vintage wine, and sports memorabilia all combine passion with profit potential. A 1962 Ferrari 250 GTO sold for $48 million in 2018. Basquiat paintings have appreciated over 1,000% in the past decade. A 1952 Mickey Mantle baseball card sold for $12.6 million in 2022. Rare Rolex watches consistently outperform the stock market. The key to collectibles is rarity, condition, and cultural significance. Original works by dead artists can't be replicated. Classic cars from discontinued models become more scarce over time. Sports cards of legendary players gain value as nostalgia increases. Modern technology has democratized collectible investing. Platforms like Rally Road let you buy shares in classic cars, sports memorabilia, and collectible assets. Masterworks allows fractional ownership of blue-chip artwork. Even Pokemon cards are now tracked as legitimate alternative investments. The psychological advantage of collectibles is that they don't feel like investments. When the stock market crashes and your portfolio drops 30%, you don't see the daily price fluctuations of your art collection or vintage guitar. This emotional stability helps you hold for the long term. Plus, collectibles provide utility beyond financial returns. You can enjoy driving a classic car, wearing a vintage watch, or displaying artwork in your home. They're investments that enhance your lifestyle while protecting and growing your wealth. The wealth preservation strategy. The wealthy don't put all their money in one asset class. They diversify across all 6 categories I've outlined. A typical wealthy portfolio might be 20% precious metals, physical and ETFs, 15% industrial commodities and mining stocks, 10% foreign currencies and international bonds, 25% dividend stocks and REITs, 25% real estate, direct ownership and REITs, 5% collectibles and alternative investments. This diversification protects against every type of economic scenario. If inflation explodes, commodities and real estate rise. If deflation hits, bonds and cash perform well. If currencies collapse, precious metals shine. If the economy grows, stocks and real estate appreciate. The key is rebalancing regularly. When one asset class outperforms, sell some and buy more of the underperforming assets. This forces you to sell high and buy low systematically. Your financial future starts now. The choice is simple. You can keep your money in the bank earning 0.5% while inflation destroys your purchasing power, or you can start thinking like the wealthy and diversify into real assets that preserve and grow wealth. The wealthy didn't get wealthy by accident. They got wealthy by understanding that cash is trash and real assets are king. They buy what the masses sell and sell what the masses buy. They think in decades while others think in months. Every day you delay is money lost to inflation. Every month you keep cash in the bank is wealth transferred from you to the system. The time to act is now. Start small if you need to. Buy a gold coin, invest in a dividend ETF, purchase shares of a REIT, open a Treasury Direct account. The important thing is to start. Your future self will thank you for taking action today, because while everyone else is watching their cash lose value, you'll be building real, lasting wealth that can survive any economic storm. The choice is yours. Stay broke with cash or get rich with assets. What's it going to be?